The mission here is to pull out the most important bits of knowledge from this source, give you a kind of shortcut to being really well informed about indicators.
Sounds good. Where should we start?
Let's start right at the beginning. When we say indicator, what exactly is that?
Okay. Fundamentally, it's a number, a statistically calculated number.
Right.
It's based on the prices of a specific chosen group, like a basket of financial assets or commodities, things traded in the market.
So like stocks or oil, things like that.
Exactly. And the way it works typically is each item in that basket gets a weight, usually based on its market value.
Okay.
Then you add up all those weighted values and you divide that sum by a fixed number, a divisor.
Okay, so it turns all that complex data into just one number you can track.
Precisely. A single digestible metric. It's designed to simplify.
And I guess we see examples of these all the time, right? Even if we don't call them indicators.
Oh, absolutely. You hear about the Consumer Price Index, the CPI.
Yeah, the inflation number.
That's a classic indicator. It tells us how much everyday living costs are changing. Or, in the stock market, you always hear about the Dow Jones or the FTSE 100 in the UK.
Those big market benchmarks.
Those are indicators, too. They give you a snapshot of how a whole section of the market is doing.
What's really fascinating, though, is what you can do with that number. It's more than just a score, isn't it?
Oh, much more. Its uses are, well, they have many facets. An indicator can be like a barometer for a country's whole economy, a real-time snapshot.
Like taking its temperature.
Kind of, yeah.
And it can also be a powerful tool for looking ahead, maybe offering hints about where the economy might be going.
Predicting trends.
Trying to, yes. And for investors, it's a crucial signal. It shows market feeling, market movement. Is it going up? Is it pulling back?
So it's like the pulse of the economy, in a way.
That's a great way to put it. It really is one of the closest things we have to feeling the pulse of the global economy.
Okay, so if they're that important, how are they actually built? What goes into calculating them? I imagine it's not simple. It's quite varied, actually. The foundation can be different things. Sometimes it's old prices, historical data.
Okay.
Sometimes it's current prices, what's happening right now, or even what the market expects to happen.
Future expectations. Interesting.
Yes, and they can look at different time frames, short-term, long-term. Often they'll use things like the daily highs and lows from trading.
The charts you see with the lines going up and down.
Exactly. Those graphical charts often visualize data pulled for indicators.
So it seems like the specific ingredients in the recipe really matter. It's not just what they measure, but how they put it together.
Absolutely spot on. What makes one indicator different from another isn't just the stuff inside it, the components. It's also the weight. You called it gravity earlier, which is a good word assigned to each part.
Right.
And really critically, the exact calculation method they use. That's what defines it.
And why is that precision so important?
Well, if you connect this to the bigger picture, think about it. These aren't just numbers for analysts. They underpin trust in the financial system.
How so?
Imagine if a key indicator like inflation or GDP growth could be calculated differently by different people or easily manipulated. It would cause chaos, right? Investment decisions, government policy, everything relies on these numbers being stable and reliable.
So there have to be some core principles, some characteristics that make them trustworthy.
Exactly. And the source points out 3 really crucial ones common to all the well-known, respected indicators.
Okay, what are they?
First is accuracy. This means you need total clarity. What exactly is in the indicator? Where did the data come from? When was it collected? How are the weights worked out? Even how are the numbers rounded? Every detail has to be specified.
Wow, okay. Very precise.
Very. Second is objectivity. The calculation method has to be so clear, so complete that there's literally no room for disagreement about what the indicator's value is at any given time or place. Anyone should be able to replicate it, basically.
No wiggle room.
None. And third is transparency. This is about how the number gets out there. It has to be announced at regulated, set times, in set places, through specific channels. No surprises, no ambiguity, no sort of ignorance about when or how you get the information.
Accuracy, objectivity, transparency. Makes sense. They build the trust.
They're the pillars of that trust, yes.
And related to that, the source makes another interesting point. The absolute number of an indicator doesn't mean much by itself. Like if the CPI is 120, so what?
Exactly. It only gets its meaning when you compare it. Compare it to what it was before or what it might be next. A CPI of 120 means something if it was 110 last year.
So it's the change, the trend, that matters.
Primarily, yes. It represents the average change over time. That's
Right.
its main job.
Okay. Now, you mentioned indicators can be different. Can we briefly touch on the main types? Our source seems to categorize them in a couple of ways.
It does. The first way is based on how broad or narrow they are, generality and specificity. So you have general indicators. Think the Dow Jones again, or the S&P 500. They try to capture the whole market's condition.
The big picture.
Right. Then you have sector-specific indicators. These zoom in on just one part of the market, like technology stocks or energy companies or healthcare.
So you can track specific industries.
Precisely. The second categorization is a bit more technical, based on how they behave. Oscillation, range, and centrality.
Right, and the source uses some interesting terms here, some from Arabic.
Yes, which offers some nice nuance. You have oscillating indicators. The term used is mutarajiha, meaning swinging.
Swinging, like prices going up and down.
Exactly. They measure price changes over a specific past period. They show you the market's rhythm, its ebb and flow.
Okay.
Then there are centered indicators, mutamarkiza. These tend to point towards potential future events. They're more forward-looking, trying to anticipate shifts.
Like predictive signals we talked about earlier.
Sort of, yes. And finally, there are oscillating range indicators, mutarajiha machalia. These swing too, but within specific boundaries, specific ranges.
What would that tell you?
Often they signal conditions like a market being overbought, maybe prices have gone up too fast and might correct, or oversold, maybe prices have fallen too far and could bounce back. Very useful for traders.
So knowing the category helps you understand what kind of signal you're actually getting.
Definitely. It tells you what the indicator is designed to measure and how it's likely to behave.
Okay, this is all fascinating background, but now we get to something really unique in our source material. It draws a very clear line between what's allowed and what's not allowed when using indicators, specifically from a Shari'ah perspective.
Yes, this is a key part of the document.
This feels like a real aha moment, especially for anyone interested in ethical finance or Islamic finance. Can you walk us through this distinction? What's okay and what isn't?
Absolutely. The source lays out a framework where indicators are generally seen as permissible, even useful, when they function as tools.
Tools for what?
Tools for information, for evaluation, for managing risk within acceptable bounds. For example, using an indicator simply to understand how much a market has changed. That's fine.
Just getting information.
Right. Or using an indicator as a benchmark to judge how well a professional fund manager has performed. You compare their returns to the indicator's return.
Okay, performance measurement.
Yes. Also, using them to get an idea about your own portfolio's performance or to estimate systematic risk, that's the risk inherent to the whole market.
So analysis and risk assessment.
Exactly. Predicting future market conditions based on indicator patterns, trying to discover potential trends again, using it as an informational tool to guide decisions. That's generally permissible.
It sounds like the key is using it to inform an action, rather than making the indicator the subject of the action itself.
That's a very good way to put it, yes. For instance, using indicators as a comparison standard in investment funds, or sukuk. Those are the Islamic financial certificates, kind of like bonds, but based on asset ownership. You can even link a manager's reward or an agent's fee to how well they perform relative to an indicator, provided it's tied to actual outcomes, like speculation results within allowed boundaries, not just betting on the number.
Interesting. What about within specific contracts?
That's covered too. For example, in a Mirabaha contract that's a common cost-plus sale in Islamic finance, you can use an indicator to help determine the profit margin initially, in the promise stage. But crucially, the final profit in the actual contract must be fixed and known. It can't fluctuate with the indicator after the deal is struck.
So the indicator helps set a term, but doesn't create ongoing uncertainty in the core obligation.
Precisely. Another example is variable rent or wages. You might use a price index, like the CPI, to adjust wages periodically in an employment contract. This is generally allowed, linking pay to cost of living changes as determined by experts. Though it notes if wages become a debt, then debt rules apply. You can also use an indicator to set boundaries for someone acting on your behalf, like restricting a speculator or agent based on certain indicator levels, or tying the execution of a binding promise, say, a promise to buy or sell something later, to a specific indicator level being reached relative to the commodity's price on a set date.
So setting conditions.
Yes, conditions for executing an otherwise valid agreement. Even tying the amount of a charitable donation, if payment is delayed, to an indicator is mentioned as permissible. The common thread is the indicator serving as an objective reference point within a legitimate underlying transaction or framework.
Okay, that covers the permissible uses.
Hmm.
What about the other side? What's strictly forbidden according to the Sharia perspective?
This is where the lines are drawn very clearly. The main prohibition is trading the indicators themselves.
What does that mean exactly? Buying and selling the Dow Jones number.
Essentially, yes. Entering contracts where you're just exchanging money based purely on whether an indicator goes up or down, without any actual buying or selling of the underlying assets that make up the indicator. It's seen as pure speculation, like gambling, on the number itself.
So no contracts for difference, CFDs on indices, for example.
That would likely fall under this prohibition, yes. Also, dealing with the intention of just hedging, protecting against potential loss without an actual underlying legitimate transaction to protect, just hedging for hedging's sake.
Okay, what else?
Concluding options contracts on indicators is forbidden. Buying the right, but not the obligation, to transact based on an indicator's future level.
No index options.
Correct. Also, contracts based on multiples of indicators. This sounds like leverage trading, where your gain or loss is magnified based on the indicator's movement. This involves excessive risk or uncertainty, known as gharar, which is prohibited.
So high leverage based just on the indicator is out.
Yes. Another point is suspending a contract's validity on a future indicator level. For example, saying, this sale contract is only valid if the FTSE reaches X by Y date. That introduces too much uncertainty into the core agreement itself.
Makes the whole deal contingent in a way that's not allowed.
Right. And finally, a very important one, tying the amount of a monetary debt in a loan agreement to a price indicator. So you borrow $1,000, but you agree to pay back an amount adjusted by inflation using a CPI indicator.
Why is that forbidden?
Because it's seen as potentially leading to riba, or interest. The amount repaid could be more than the principal purely due to the index change, which resembles interest on a loan. Debt amounts generally must be fixed.
That's a really clear set of distinctions. So let me see if I've got this. It really boils down to purpose and mechanism, right?
I think so, yes.
Is the indicator being used as a helpful tool for information, evaluation, setting a clear variable within a permissible contract? That seems okay. But is it being treated like a commodity itself, something to be bought and sold directly? Or used in ways that create excessive uncertainty, gharar, or look like interest, riba? That's where the line is crossed.
That sums it up very well. The underlying transaction and the way the indicator is integrated are paramount from this perspective.
Okay, this leads perfectly into the final part of our source material. If you want to create an Islamic indicator, one that complies with these principles, what do you need to do? What are the controls?
The source outlines 3 essential controls for establishing a genuinely Islamic indicator.
What's the first one?
Unsurprisingly, the first is strict adherence to Sharia controls in everything. The components chosen for the indicator, how it's calculated, and how it's intended to be used all must align with established Islamic financial principles. No prohibited companies, no prohibited contract structures linked to it.
Foundational Sharia compliance. Got it. What's second?
Second is adherence to technical controls. This goes back to what we discussed earlier: accuracy, objectivity, transparency. The indicator needs to be well built from a statistical and financial standpoint. Reliable, robust, transparently calculated. Sharia compliance doesn't negate the need for technical excellence.
Right. It has to be a good indicator as well as a compliant one.
Exactly. And the third control is quite distinctive: the mandatory existence of a Sharia supervisory board.
Like many Islamic financial institutions have.
Yeah.
What's its specific role here?
Its role is active, not passive. This board must specifically verify that the indicator's components and all its intended or potential uses are actually Sharia compliant.
So they vet everything up front.
Yes, and it doesn't stop there. They're also required to review the indicator periodically to make sure it stays compliant as markets or components change, and they need to issue a formal Sharia report on it.
So ongoing oversight and certification.
Precisely. It provides that crucial layer of ongoing governance and assurance that the indicator maintains its integrity according to Sharia principles over time.
Wow. Okay. We have definitely covered a lot of ground in this deep dive. We started with defining indicators, looked at how they're built, the different types, and then really dug into that critical distinction between permissible and impermissible uses from a Sharia viewpoint based on our source. And finally, the specific controls needed to build an actual Islamic indicator.
It's a thorough framework, really combining technical financial aspects with deep ethical and religious considerations.
It absolutely is.
Yeah.
And exploring these details, especially the Sharia perspective, naturally leads to a final thought, something for you, the listener, to mull over.
Yes, this journey raises an important question, I think. How might understanding these specific distinctions, particularly around what makes a financial tool or practice permissible or impermissible from this ethical viewpoint, how might that challenge or perhaps deepen your own perspective on financial innovation and ethical investing, even beyond what we've explicitly talked about today?
That's a great question to leave things on. Something to really think about in terms of where finance is heading and the different ethical lenses we can apply.